this order block here, and then we have a higher down close candle here. This is a propulsion block. So any retracement here should be kept at bay. It should not go below the midpoint of that candle. That's the rules for a propulsion block. Meaning that if this is going to rally, it should not go through halfway. We'll just eyeball it and use that high here because it's approximately it. So let's watch this and study it. Okay, and we have a small little fair value gap here now. Get this out of the way. See how it came down and touched the top of this candle, the open? But my eye is here, and that right there. We don't want to see that. We don't want to see it go through it. It can touch it, but we don't want to see it go through that. Propulsion block, and these are the rules are in the core content. If it trades through it, then it's, in my opinion, probable cause for it to want to go down into this area here. Okay, trading up into the volume imbalance. We're below it, so it can trade up to the high end of it and actually go through this. Volume imbalances I'm a little bit more flexible with because they're such a small little range, and as I was teaching last night, the market likes to see a seamless delivery, meaning that if this is the level, it might overshoot a little bit. So how far can it overshoot to this candle's low? That's permissible. Okay, as I mentioned a little bit ago, if it were to go back up and overshoot it, this is permissible. This coming all the way back up to midpoint of this, that's reasonable. It's rare that it comes all the way back up, as I was mentioning last night with the balanced price range. So it would need to immediately reject this and go lower if it's going to go lower. See, these are all the things that I'm looking at price, and does it do these things? These are signatures and price action that I'm looking for to either confirm or negate an idea that I'm watching or studying, maybe for an entry or managing an open position. Or in this case, tape reading with all of you. And be mindful of the volume imbalance. One of the things that you're going to have is a source of confusion, frustration, is knowing which PD arrays to be more flexible with. Come on. There we are. And one of those are my volume imbalance. So I allow price to move through it back and forth, and then come back and use it again as a support or resistance level. The fair value gaps, I'm not that loose with. Like, I'm demanding them to do specific things. Now, if they're broken and price goes away from them and comes back and goes back above them or below them, then it can be reclaimed. But back and forth type price movement like we're seeing here, that's, for me, and what I've grown to trust with my volume imbalance, which is again the separation between two candles bodies, but the wicks can touch or overlap, that's fine. The identification of that in price action. Let me put this in here too, because I saw a couple people mention it. They're saying that their broker feed or their broker doesn't show, or sometimes if they're looking at the micro account or micro contract, first, like this is a mini, and the micro MES, sometimes it doesn't show the volume imbalances on there. I'm not aware of that because I don't really watch the MES, but the way you would combat that is simply just watch the price action of mini and trade with that insight. Here's the mean threshold. I'm sorry, the consequent encroachment of the fair value gap here. So now our attention goes to the right below here, and this specifically. So we have this buy side imbalance, sell side inefficiency, the lower end of it here, sell side, And we have an order block here. So let's see if we get the price to want to dig down deeper a little bit. Volume and balance, volume and balance. So it can reprice back up into this area here, but it would be better if it didn't. Because pushing back up into that, if it launches through it, then we're going into this area here. So you're probably thinking, what's the benefit of this? Well, what's the benefit of watching price action today? It was rather lethargic, choppy in certain times, and we were covering it in Twitter. And then ultimately, I gave a 10-minute filter. I was like, okay, I'm going to give it 10 minutes and see what it does. And then it gave me something to work with. And I outlined it, walked you through it, and I'm sure some of you did what you weren't supposed to do and trade it. And I called the high at 41.0150, which at this moment still is in place as the daily high. And this morning, really early before the New York session, I mentioned the low, right to the tick. So both high and low have been shared with you. Goober on Twitter was telling me, oh, but why'd you say it could go? Because anytime a Fed speaker, anybody from the Fed is talking, it can create wild price action. And when you're new to trading, you don't understand that. So you have to make available allowances for you being inaccurate, or traditional expectations or rules go out the window when Fed gets involved. So the Fed effect is, all the rules go out the window, and you got to prepare for that. So the low I called this morning, and the high that I have here, when a Fed speaker or Fed representative is jawboning and talking, their words are going to be utilized as a smokescreen for price to do what it's going to do. But you're told it's the market reacting to what they're saying. And I'm sorry, I'm not a subscriber to that view. Look how spotty price is right now. And meaning, what do I mean by spotty? You have volume imbalances in here, 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 and the one over here. So it makes it difficult to get a real smooth, like obvious run to this price level, react and go lower, or run to this price level, react and go higher. So it can go back and forth because it's referring to all of these specific PD arrays, which makes reading price and taking a trade much more difficult to trust. And where would you place your stop loss? Because it can bang around in here and then ultimately run on one of them as its baseline premise, with supporting it as the PD array or the multiplier for price to start moving away from. Now, if we were to rally and come back down and find some support here, then I think, because of time being 3:30 now, we might see a macro run us up into these highs here and take out the buy side that's resting over here. So one of two things are going to happen if that's exactly what's going to unfold, and I'm not 100% certain it's going to do that, but I'll stick with that narrative here. If it goes above it, finds the support here, then it would look to rally. Otherwise, it's going to rip right on through and not even look back at it. Range expansion. Usually when you see me doing my recorded trades, I'll type out and say, I want to see speed and distance, or sharp decline. If I'm looking for it to be bearish, I want to see big range up, green, big up candles. That's what I'm saying. Like, I want to see large range green up close candles. You see how fast we went right to the consequent encouragement? That's that mid-level right here. When I see that, I feel like that's like a confirmation that you would be on side and I'm on side if I'm expecting that. So I would reasonably expect to see it to go through here. Now, if it goes through here, we want to see it expand up with a lot of velocity and speed, so that way it can dig into this level over here and take out that high, which in my heart I wish I would just not see it taken out, because 41.01.50, even though my last contract didn't get a fill because of the spread. And now we want to see an energetic big run up into like 41.04, 41.05. big candles, pushing really hard because there's a lot of orders that are resting up here that are layered. That means they're like all up in here. The books will tell you to put it right above the high, but some other traders and fund traders will think, okay, well, let me just go a little bit deeper than that, and I'll be really protected. And that's why when you see in the later parts of the day, the old intraday highs and lows, they'll get really ran out because they're seeking the liquidity of the funds. And funds have their stops, not just one tick or 1 point above it. It's several handles above it, as much as 10. So what you do with the algorithm in the last couple minutes of trading, if you identify a liquidity pool that is likely to be ran out, which is what we were watching today, we were looking for this here. If it runs through it before 10 minutes of, then the macro will run through it aggressively and reach for liquidity that's resting above the high. But since we hit it ahead of and went through it ahead of, here, you see what time it is? It's 3:48. That means it's already delivered running through the high here. So it's going to have a small little flurry. It might go up here, but then the macro will dig back into the daily range. Why? Why should it do that? In an up close day, rarely, and it's not a trending day, but rarely do you see the candle close on the high, unless it's a trending day. Typically what will happen is it creates the intraday high of the day, then it pulls away from that high and closes near the high. So it won't be on the highs, it'll be off the high. So that's what that market on close macro is doing.